So this is going to be the beginning of 15-2, and we're going to be doing the adjustments for merchandise inventory and interest receivable. So a lot of new vocabulary here, but we've done this before again with the with the merchandise inventory. We have a beginning inventory. This is the merchandise we're selling to our customers. We might purchase more throughout the year called purchases so that we can have more to resell. And then when we do a physical count, we determine how much we have at the end of the year. And we could be buying more throughout the year, but we have to determine how much we have spent on our merchandise. So recording the adjusting entry for merchandise inventory, we have that unadjusted trial balance that we did previously with the amount of the merchandise inventory. And then they'll give us a balance as after a physical count. Typically, we would subtract like we've done before, and we would debit the income summary and we'd credit the merchandise inventory. However, there could be times like what's going to happen in 15-2 here that we're going to have more at the end of the year than we did at the beginning. So then these accounts would be reversed. We would debit merchandise inventory and we would credit income summary, because remember, we don't have a normal balance for income summary. So we'll stop the PowerPoint there. Remember, the PowerPoints and the notes are in your Google Classroom under Chapter 15. So here is the work together for 15-2, and we have the adjustment data, two information pieces here, and we have that unadjusted trial balance. So the first thing that we have to do is read the directions. It says to journalize the entries for the adjustment. These are the previous ones we did in 15-1. I'm going to get rid of the answers again. And we have to do the merchandise inventory and the interest from the notes receivable here. So these are the previous ones, and they're all going to be the end of the year. And it says from a physical count of merchandise inventory, the December 31st balance is determined to be $96,471.25. Journalize that adjusting entry. So we're going to take this merchandise inventory amount here, $94,845.31, and subtract the amount given. We are going to come up with a negative number here. So instead of a negative number, like I explained with the journalizing, we're going to reverse the debits and credits. So instead of income summary being the debit and merchandise inventory being the credit, we now have to reverse it. So merchandise inventory will be the debit, income summary will be the credit, because we have an ending balance that was more than our unadjusted trial balance. So I'm going to put the answer in to our adjustments right here. So this is what this will look like now, December 31st. Remember, we had a negative balance, so that really means that there's merchandise inventory is going to be your debit. So when we took that amount of merchandise inventory, this 94,000 number, remember we had this ending balance here. So the difference is the $1,625.94. So in this case, merchandise inventory will be the debit, income summary will be the credit. The last one is it says a single note receivable is outstanding on December 31st. The 90-day 8% note was signed on November 22nd. Journalize the adjusting entry for the interest receivable. Okay, the second entry, this single note thing here. We have to determine what the amount is and how to figure out what this note is all about. So 90-day 8% note was signed on November 22nd, and we have to journalize the adjusting entry for interest receivable. So we're gaining interest on this note. Remember, a note is kind of like an IOU, and somebody's going to pay us back that amount of money plus the interest. So to figure out the days, first of all, I got a couple of formulas up here. So November 22nd, we have to determine how many days are in November, which is 30. So we're going to go from November 22nd to the 30th, determining there's 8 days in that time period. And then all the way to December. So December has 31 days. So 8 plus 31 is 39 days. And that's where we're getting this information, the 39 over 360. Where did I get this 8,000? So over here, we open up our adjusted trial balance, and we see notes receivable. So that's the note that we gave somebody that they're going to pay that note back to us plus interest. So that $8,000 is the note times the 8%. Where did we get that? It tells us right here, the 8% note. Multiply by how many days over 360, which is 360 in the year. So when you do that math, 8,000 times 0.08, which is the percent, times 39 over 360, we get $69.33. So now we have to journalize that amount, but this is the amount that you're going to be using right here for this entry. This is all explained as well in the notes, probably better than the PowerPoint. I typed out the formula and so forth in the 15-2 section of your notes. So this is what the entry will look like when you journalize it. So we're going to have the 31st is our date, interest receivable. So we're receiving the interest, remember, of $69.33. That was the amount we calculated. And we're crediting interest income of $69.33. So again, if you go back into the Chapter 15 notes and you scroll down to the 15-2 section, remember this is a Word document, so it doesn't look very nice in Google Docs. You can open it up as a doc if you would like to. This shows the interest or the merchandise inventory, and then down below is the notes receivable. So I give you the formula here and how to figure that all out. And the journal entry is right here in your notes. So that concludes, I believe. We only had the one step for 15-2. This is the work together problem. Go ahead and try the on your own problem as well. Just be careful with the on your own to make sure, remember that second one, it could be income summary debited and merchandise inventory credited, just depending on if the balance at the end was larger than at the beginning. Feel free to email me if you have any questions or problems.